What's up, everybody? Jamie Dimon, the CEO of JP Morgan Chase, recently warned that several headwinds, including persistent inflation, Federal Reserve policy, and ongoing multiple wars, pose a real threat to the U.S. economy. Many economic indicators continue to be favorable. The chief executive of America's largest bank said in a release announcing first quarter earning results. However, looking ahead, we remain alert to a number of significant uncertain forces. He thinks it is very possible for interest rates to go back up to 8% as the effects of the unprecedented monetary policy taken to combat inflation take hold. If rates do spike, or if economists' recession forecasts are too bullish and a recession hits, Dimon warned that the future of the real estate industry is in trouble. So today, we'll take a look at Will Daniels' article in Fortune titled, Jamie Dimon says stagflation is real estate's worst case scenario that will filter through the whole economy in a way that people haven't really experienced since 2010. To see what he's saying and how this affects the future of the housing market. And as usual, I will chime in with my opinion as well. So let's dive right in. Last Friday, CEO Jamie Dimon told his investors in JP Morgan's first quarter earnings release that while economic indicators remain favorable and both consumers and businesses are in good shape for now, he sees a number of significant uncertain forces that could spoil the party. Dimon called the geopolitical outlook unsettling amid the Russia-Ukraine and the Israel-Hamas conflicts, warned of persistent inflationary pressures, and said the full impact of the Fed's tightening monetary policies has yet to be felt. And that's not all. Daniel writes that while most economists have abandoned their recession calls this year in favor of a more rosier but more inflationary outlook for the U.S., Dimon says he is far less optimistic and a moderate recession remains a possibility. We're okay right now. It does not mean we're okay down the road, he told analysts. I'm just on the more cautious side. Everything is okay today, but you've got to be prepared for a range of outcomes, which we are. A recession would be terrible news for consumers, but Dimon went on to elaborate what would be the worst case scenario for real estate and possibly the whole economy, which would be stagflation. We are prepared for a very broad range of interest rates, from 2 to 8% or even more, with equally wide-ranging economic outcomes, from strong economic growth with moderate inflation to a recession with inflation, i.e. stagflation, Dimon wrote. Stagflation, a condition where you have slow economic growth, stagnation, rising prices, inflation, and rising unemployment happen all at the same time, was one of the main fears of the pessimistic economists back in early 2023 and late 2022, when inflation was still near a 40-year high. Since then, inflation did start to cool over the last 18 months, but after the last 3 hot inflation reports in a row, stagflation fears are back. Daniel cites in the article that rising oil prices, geopolitical tensions that are forcing supply chains to reroute, and record government spending are driving prices higher, even after the Federal Reserve's aggressive rate hikes in 2022 and 2023. Dimon believes that as long as rates don't continue to rise, the real estate industry should be okay. However, if rates do spike or a recession hits, he warned the outlook won't be so bright. They won't muddle through under higher rates with the recession, the CEO said. That will be tougher for a lot of folks, and not just real estate, if in fact that happens. Dimon clarified that what really matters is the reason interest rates are rising. If that happens because we have a strong economy, well, it's not so bad for real estate because people will be hiring, he explained. If that happens because we have stagflation, well, that's the worst case. Dimon described what that dire scenario may look like for real estate. And it doesn't sound great. All of a sudden, you're gonna have more vacancies, you're gonna have more companies cutting back, you're gonna have less leases, he said. It will affect everything, including multifamily, that will filter through the whole economy in a way that people haven't really experienced since 2010. Interestingly enough, what we're seeing in our country right now is that even with these higher interest rates, people are still buying houses. houses, escalating home prices even higher. NAR data shows that the recent sales for existing homes are near record highs. February 2024's median sale price of $384,500 is off the all-time high of $413,800, but is the highest February median on record. Prices will remain firm and will not decline on a national level, said Lawrence Yun, the chief economist for the NAR, the National Association of Realtors. Home prices have also risen more quickly than wages, a reality that exacerbates the affordability crisis, says Yun. Anytime home prices outpace people's incomes, that's not good, Yun told reporters recently. The result is a squeeze on first-time buyers, but repeat buyers can rely on gains from the housing market and their stock portfolios to finance purchases, Yun said. One thing they all seem to agree on is that the main reason prices are so high is due to the lack of inventory. You're not going to see house prices decline, says Rick Arviello, head of mortgage firm New American Funding. There's just not enough inventory. Skylar Olson, Zillow's chief economist, agrees that it's only going to get worse. Her recent forecast says home prices will keep rising in 2024. Good news for sellers, but not so great for first-time buyers who are struggling to afford to buy a home. We're not in that space where things are suddenly going to be more affordable, Olson says. Mark Fleming, the chief economist at First American, also thinks home prices will continue to go up. There's just generally not enough supply. There are more people than housing inventory. It's Econ 101. Dave Liniger, the founder of the real estate brokerage RE/MAX, believes that if mortgage rates do go down meaningfully, it could send a new wave of buyers into the market, therefore pushing prices up. You've got an entire generation of pent-up demand, Liniger says. We're in this fascinating position of tremendous demand and too little inventory. When interest rates do start to come down, it'll be another boom and bust cycle. This is not to say that home prices haven't cooled in certain overvalued markets. But even with a home price correction, home values are still much higher than they were pre-pandemic. Adding to the supply problem is that a lot of people refinance their homes to have mortgage rates that are way less than 5%, some as low as 2.865%. So these would-be sellers are choosing to stay put rather than give up this historically low interest rate. This lack of supply, coupled with stricter lending requirements and increased equity, basically assures us we will avoid a housing market crash like back in 2008. We simply don't have enough inventory, Yun says. Will some markets see a price decline? Yes. But with the supply not being there, the repeat of a 30% price decline is highly unlikely. If lending standards loosen and we go back to the wild west days of 2004 to 2006, then that is a whole different animal, says Greg McBride, Bankrate's chief financial analyst. If we start to see prices being bid up by the artificial buying power of loose lending standards, that's when we worry about a crash. Chen Zhao, the lead economist for Redfin, thinks home prices may go down by the end of 2024. Housing costs are likely to continue going up for the near future, but persistently high mortgage rates and rising supply could cool home price growth by the end of the year, taking some pressure off costs. In Redfin's latest housing market update for the 4 weeks ending April 7th, the median sale price is up 4.5% year over year. Metros with the biggest year-over-year median sale price increases are Anaheim, California, up 22.2%, West Palm Beach, Florida, up 17.4%, and Pittsburgh, up 15.2%. The metro with the biggest year-over-year median sale price decrease is San Antonio, Texas, down 1.7%. The median asking price is also up 6.5% year over year. New listings are up 14.1% year over year, the biggest increase since June of 2021. The metros with the biggest year-over-year increase in new listings are San Jose, California, up 56.8%, Sacramento, California, up 39.2%, and Austin, Texas, up 30.7%. The metros with the biggest year-over-year decrease in new listings are Newark, New Jersey, down 3.1%, Milwaukee, down 3%, and Chicago, down 2.9%. Active listings are also up 8.2% year over year. 42.5% of the home homes for sale sold in the first 2 weeks, down from 44% a year ago. The median days on the market is 37 days, down 1 day from a year ago. 28.4% of the homes for sale sold above the list price, unchanged from a year ago. And 5.8% of the homes for sale did have a price drop, up 1.5 points from a year ago. If you missed last week's video when Meredith Whitney, deemed the Oracle of Wall Street, predicts that home prices will fall 20%, definitely check it out next. Thanks for watching. I do appreciate it. Bye!